for a broader understanding of what's going on, where things could be headed, we're joined by Sunil Subramaniam, CEO of Sundaram Mutual Fund, to take some questions. Hi, Sunil. Good morning, and thank you for joining us as always. We're pretty much at the end of the earnings season, right? So first up, take us through how you look at this entire season. Has there been any standout performer for you, a standout, sector that has done well? And tell me, barring the banks, because, everyone likes the banks.
I think, yes, banks will be there. But like you said, everybody likes the banks. But auto, I think, with about 36% earnings growth has been a massive positive this quarter, I would say. And on the massive negative, of course, has been the metals pack. I think these two are the ones. Overall broad, I think large caps have grown about 16% and middle small cap about 18%. So there is a gradual shift of the earning growth cycle with India going through, what do you call that, bullish phase, right, in terms of the economy. I think the mid and small cap earnings will gradually start showing better and better guidances and actual numbers.
Sunil, of late, we've seen the domestic institutional investors sell in the cash market as the FIs have been buying. In fact, one of our speakers very recently told us that the cash levels held by domestic mutual funds are at a 24-month high. Can you tell us what is happening? Why are domestic mutual funds selling out? What are they selling? Are they waiting for better, lower levels in store?
So I think that basically if you see that domestic mutual funds have been consistent buyers for a very long period of time. And in this period, if you see post-COVID, domestics were sellers because the investors were buying. But after that, it's from April 2021 onwards, mutual funds have been substantially receiving flows. Between October and June of last year, you saw oil prices go up and FIS pull out about 2.5 lakh crores. So that correction meant that domestic MF deployed a lot at the corrected valuations across the board when the FIs were selling. Now, since then, what happened? Again, in Jan and Feb, due to the Adani crisis and the banking crisis, FIs were net sellers till about 15th of March. Again, domestics went and bought a lot of stocks they thought were reasonably valued. Now, post-March 15th, the FIs bounced back, right? 40 to 50,000 crores has come back. And look at it from a trigger perspective. What the FIs? Why? Because the news on the international got worse. Because the dollar started weakening. Because the interest rates, though the Fed is not committing to a rate cut, the markets, clearly the gold, the equity, and the debt bond markets all are predicting a early rate cut and a weakening dollar. This makes the situation very conducive for money to flow into emerging markets. And with oil stabilizing and slightly dropping from the mid-80s to the mid-70s, there was this sudden rush of FII money. Now, when that came in, right, nothing particularly had changed in the Indian economy for there to be such violent moves of the FII flows. This is entirely international linked. So when all of this rush of money came in, it came in across the board into a lot of sectors where valuations were already trending high because domestics had been buying. And now with the FII buying, they took them to newer levels. So naturally, when looking at it from a growth versus value perspective, there were a lot of sectors and within sector specific stocks where the valuations seemed to be rich, and we needed to wait for the earnings season to play out to see whether those were justified and what the guidance was coming through. So I think this taking of cash, it's been across the board, cash levels have increased, is basically a function of the fact that the FII across the board buying meant there are sectors where mutual funds have made a lot of money, a lot of profits. They are taking some money off the table, keeping it in their, buying power. And as this earnings season is played out, by and large, it's not been disappointing. It's been okay. But the guidances are different for different sectors. So I think this is just a phase of keeping the cash and being ready to deploy.
Sure.
Second one is away from international to domestic orientation. So what they've been selling is FIs are generally buying international orientation, like IT, those which they are comfortable with. But domestics, mutual funds are also increasingly looking domestic inwards. So that reallocation of portfolio is what's currently happening. There's no negative view on the economy or the market.
Okay, so it's just IT where we are seeing domestic institutional investors bring down their holding, or are there any other sectors?
Metals.
IT and metals.
Global cyclicals, I would say. So energy, power, metals, anything which linked to the global cyclicality, and then IT, and to some extent pharma too. Though the numbers from pharma look okay, the fact is that the prognosis for pharma in a time when the world is slowing down is not exactly very, very rosy. So very stock specific, domestic pharma oriented, they're buying, but international pharma, they're probably taking money off the table a little bit. So all international oriented global cyclical sectors is where I think money is being taken off the table by domestic MF and will be redeployed in domestic sectors in the coming months.
Okay, Sunil, I take that point, but tell us, from here, how do you think things will move? Is it that DIIs have, got out now and because they've made such money, they've moved out of some of these spaces? Do you think that now with the Q4 earnings season as well out of the way, they'll look to sort of get back into the market, look at the sectors which have perhaps done well, assess the performance and then get back? Or do you think this trend of MF inflows coming down a bit is likely to continue? At least I'm talking about just the next few months.
No, I think next few months they'll be bounced back by domestic investors buying, but it'll be reallocated. They'll not buy what they sold.
Yeah,
so
sure.
Earnings season, right? Well, the numbers were good. Like I said, it's a guidance about the next few months. How is the oncoming festival season, right? We're not too far from a festival season. So consumer discretionary will get a boom. They'll probably redeploy into consumer discretionary away from consumer staples, right? So they will do reallocations smartly. And like I said, these cash levels, mutual funds do not have the mandate to keep large amounts of cash for long amounts of time. It's a tactical call temporarily because of valuation and a reallocation happening. So the leadership of the sectoral growth of the markets is, I think, going to change in favor of domestic oriented sectors.
Sunil, some sectors like defense, railways, now electronic manufacturing services, these are companies which are doing well, the sectors where the growth outlook is fairly positive, valuations notwithstanding. But how does one get access to these, particular themes, niche themes and sectors? What's the best way to play it via the mutual fund route?
I think the best is to focus on a multi-cap mutual fund. Why do I say? Because a lot of these sectoral companies are very few in number, but they are available largely in the small cap and the mid cap space, right? So I think that a multi-cap which has, let's say, a 25-30%, small cap, 25-30 mid-cap, will go and pick the smarter stocks, rather what they perceive as the growth stocks there. Whereas a normal mid-cap fund would tend to buy across the board all the sectors, right? So in a multi-cap fund, since he has 25% of his portfolio to deploy in small cap, he will generally choose those which have a growth orientation, which are the sectors that you mentioned, right? Manufacturing, industrials. So I would say a multi-cap fund for an investor is the best way to play because there aren't enough companies listed for a sectoral play to be permitted into these sectors, right? If you take an infra fund, for example, not necessarily they'll get exposure only to these. You'll get again a broad-based over a range of infra sectors, right? Very hard to play from a sectoral theme perspective. I would recommend to choose multi-cap funds as the best way to play these themes.
Yeah. Since Reema mentioned defense, recently there's India's first ever defense sector fund, which is, I'm not recommending it or anything at all. HDFC did launch that defense sector fund. So there's clearly a lot of action in that space, but these stocks have also run up so much. So, I mean, not a recommendation by any means, but there is that fund which has been launched.
But, yesterday, Prashant was chatting with Jeffries, Mahesh Nandurkar, I think. And he was broadly asking him on capital goods, etc. He's like, valuations have run up. Because capital goods are industrials. But, he said that, how consumption stocks re-rated over a period of 10 years. At some point, they were 10, 20x. They went to 30, 40x, went to 70x as well.
It would have been a good point to get in at many
multiple points. So he's saying that this whole capital goods, industrials, and I presume defense falls in this broad umbrella. He's like, they have seen a valuation re-rating, but they are going to be a part of a multi-year re-rating cycle, similar to what consumption went through.
Sunil, would you buy the defense fund?
See, defense is a very narrow space, but I buy the broader industrial, infra, manufacturing, capital goods theme very well. Industrials, defense is a very narrow particular theme there, which will have its lifetime and then will have its non-lifetime. So broader industrials, I buy with the value that the valuation increases are not to be viewed. They are right now looking high on valuation because the earnings have not yet come in. It's the order books which are driving the valuation. When those earnings actually come, you will actually find those earnings will surprise on the upside and these valuations will be further getting re-rated upwards. If you look at the 2003 to 8, which was the last capex cycle in our economy, you will see this is exactly what happened. The first year, there was 100% re-rating. The second year, subsequently, there was even better. So I buy the argument which was just, spoken about, that there'll be a multi-year re-rating of the infra industrial specs, defense, everything falls within that thing. So it's a good time to buy, and it's like we are nowhere near the end of that cycle, right, for you to worried about it. But there will be periods when the valuation overshoots the earnings. Then there'll be a catch-up phase. Then the next level of valuation rise. You got to have the faith and the gumption to stick through this process.
Okay, thank you very much, Sunil, for joining in. Rich conversation. Look forward to our chat another time. Get into a break. On the other side, we'll put the spotlight on Biocon, that's surging post its Q4 numbers and the conference call.